I'm Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, the best two-person podcast in the 50-plus year history of Cabot Wealth Network. Brad, Beetlejuice, filmed in Vermont, first, both first and second, um, opened as one of the biggest box office openings of the year the past week or so. Listen to some of the top 20 box office hits this year. Beetlejuice, Twisters, Bad Boys, Ghostbusters, Alien, Garfield. It's clear that 80s and 90s nostalgia is in full swing. You and I are clearly the target demo. Are you feeling nostalgic these days or no?
A little bit, yeah. Yeah,
Yeah.
I like a nostalgia play. I enjoyed Ghostbusters. I really enjoyed, so we took my kids to see Ghostbusters and it was, actually, no, I'm thinking Ninja Turtles. We took my kids to see
There's another one.
Ninja Turtles and Ghostbusters in theaters. And I was like, hey, this is cool. And I'm a 40 plus year old man sitting in a theater with his kids watching something that was meaningful when I was younger. I want to see Beetlejuice.
Yeah, I do too. I've heard
That's
that's actually decent. I don't know. I can't speak to all of these. Actually, I heard Twisters is good too, but I have not seen that one.
I do not have any nostalgia for Twisters. The first Twister was great, but it's
Right.
like it came out in like 94. Like, all right, well,
Yeah.
that was based on my recollection, that was like 10 years ago.
Right. It's not one that sticks with you the way does necessarily, but yeah, I want to see. I don't have huge
I
time.
like
You took your kids to see Ghostbusters: Frozen Empire?
Yeah, it was fine. It
Okay.
was just I liked Ghost. I dressed up as a kid as a Ghostbuster as a kid. I used
Yeah.
to the boogeyman in the animated Ghostbusters cartoon is one of the iconic villains of my childhood. And it hit me right in the nostalgia spot
Yeah.
that studios were planning. I did see the Alien remake, or not remake, the Alien interquel.
Romulus or whatever.
Yeah, yeah, it was a B plus or B
Okay.
minus C plus kind of movie. It was like downloadable content for Alien, where it's like, hey, remember all that stuff you like about Alien? Here it is on the big screen.
Right.
It's solid, right?
Okay.
I,
Solid. I'll take solid.
but that's not. I mean, that's what Hollywood does, right? The Wizard of Oz, the 35 or 39
Right.
Wizard of Oz, was a remake. I don't know if you are aware of that, but the first Wizard of Oz came out in like 1919, and it looked super janky. Hollywood has been intellectually bankrupt and out of ideas for a century at this point.
Yeah. Well, speaking of out of ideas, let's move to our podcast for today. That's a good segue. Tell people what we're going to talk about today.
Obviously, we are going to talk about rate cuts. That was the big news this week. Fed opting to cut 50 basis points. We are going to talk about small caps sort of leading the post-cut rally and whether it's their time to shine, and then trying to assess whether the bottom has already come and gone. And then after that, we are going to each make three pitches for what we will talk about now that the Fed is switched from foe to friend and is finally cutting rates.
Yes, this will be a Fed heavy podcast because this big thing just happened, but hopefully we can move sort of past that in future weeks. So yeah, we'll talk about what we could be talking about the next 6 months. But first, as always, is defend the take, and your take, Brad, is naturally Fed related. The cut, 50 basis point cut from the other day. That is the green light that will pull cash off the sidelines and into the market. You have 90 seconds. Go.
Okay, so we'll get more into the Fed cut shortly after
Yeah.
this. 50 basis points is a slash and burn. They're projecting another 25 or 50 basis points of cuts this year, and maybe as much as 100 basis points of cuts next year. That brings cash yields down into the low to mid threes, depending on how it all goes. I should say not fully a projection, just what voting members who decide make the decision think is likely. So it's not a forecast, but it is an assessment of what they think may be coming. When cash yields get down to 3%, they aren't tenable as an investment vehicle. For the last year plus, if you're a big institutional investor and you need to make 7% a year because of your pension obligations, for instance, if you can park a lot of money in cash at 5%, you don't need to outperform with very much more of your money. So if you've got 60% of your money making 5% in cash and you've got 40% making 9.5% or so, that gets you to your 7% annualized returns that you need to be generating to manage your pension obligations. That is no longer true when cash is at 3%. When cash is at 3%, you need to be looking for your sort of mandatory returns to support your pension obligations. You need to be looking for that in the market. So the Fed taking a slash and burn stance to drastically reduce rates in the next 2 years is going to force institutional money that's on the sidelines into the market. Uh, will it do the same for retail money? I don't know. It really is dependent upon why retail money is sitting on the sidelines. If it's like future obligations or concerns about high borrowing costs or something like that, that would have a negative impact. But Fed rate cuts, low cash yields means institutions have to invest.
Yeah, I mean, I think we've talked about this. You're not going to get any pushback from me. I did I had a webinar yesterday where I showed a chart of it's one you and have passed around, the federal funds rate, or sorry, no, the money market funds, um, a chart of how much has been in there for the past decade. It was pretty fun. It was below, it was right around 3 trillion, a little under 3 trillion from like 2014 all the way through mid 2018. Then it spiked in up through all the way until the COVID, through early COVID. Partly that was the Fed. The spike was because inflation rates were hot first. Sorry, not inflation rates. Uh, the uh, gosh, why am I missing the number? Anyway, it spiked all the way till 2020. And then in March 2020, after the COVID crash bottom, it dipped, and we saw a almost 2 year, 21-month bull market from say March, April 2020 to the end of 2021. Stayed about the same, and then when the bear market hit, it started spiking again from about 5 trillion up to where it is now, $6.3 trillion. So it needs like a really sort of existential or macro catalyst, and seems like we're getting one now, especially with it looks like how the Fed is going to start cutting rates.
Yeah, and I mean it's not probably going to be like an overnight switch that gets flipped
Yeah,
because we're still, even with the rate cuts, you're still 4.75, but cash is you are in a position, if you are a pension fund or if you're a retirement system, where cash has to come off the sidelines now, which means it's probably going to matriculate into the market over the next 2 quarters. I would guess. I don't know. I mean, it's not like I'm talking to the head of CalPERS or anything like that. It's like just sort of back of the napkin math on this.
right,
But the money at this point is really has to go into the market. There's not
right,
anywhere else where you can make the kind of returns that you need to make.
yeah.
So
And this is
it's
what people have been sort of, a lot of people have probably been waiting to deploy that cash until this happened. We had Cliff
yeah.
Stroke on last week, and he said, I think this is the rare case where it's not just buy the rumor, sell the news. Seems like buy the news. There's some buying the rumor, but maybe even more so buying the news than the news being. Transitions right to our, first in our big three, the Fed cut rates. We were both wrong. We're going to have to eat some hot sauce on that
Yep.
one. We thought they'd cut by 25 basis points. We thought they've already cut what we thought they were going to cut by the end of the year. We thought they're going to cut by 25 basis points twice, once this week, once in December. If it's possible, they'll cut by a full 100 basis points now.
Yep.
Maybe they will cut in November. It seems like they will. We thought maybe election week they might stay away from that, but it's not sounding like that. I was really skeptical. You and I have generally been, right on what the Fed's going to do. We were wrong this time. And the market, I think when we sat here and did this a week ago, the majority thought along with us there's going to be 25 basis points, and then that flipped. It was what, 59% thought it was going to be 50 basis points by the time they actually did it. I'm not sure what flipped that exactly, but the market was right. And
Yeah,
Fed is serious. They're cutting it. It does seem like they didn't say this. Powell would never say this. It seems like by cutting 50 basis points, it's almost an admission that maybe we should have started in July
yeah,
and cut 25 basis points then, 25 now. Then that July, that July or the end of July jobs report that came out that really spooked people and sent the market tumbling. Seems like that spooked the Fed too. And they're playing a little bit of catch up here.
yeah. I would agree. I think that the sort of catch up element is definitely there. I mean the problem with the Fed is we're trying to like divine out what they're actually thinking.
Right.
I don't know if they want to send a message to the stock market in an election year that, hey, we're on your side now. I don't know if they're worried about jobs numbers that we should be maybe more concerned about. I mean, I think that's going to be a talking point, and I'll get more into that later. But it definitely, I think we can sort of confidently say that they should have cut in July and that they're aware of it.
Yeah.
Um, I, I don't know. I mean, like maybe they're sending a message and doing they're front loading, but their dot plot that they've got for the rest of the year and then for 25 and 26, it's pricing in a sort of a terminal Fed funds rate into the end of 26 and 27 of around 3.25%. So it seems like they're, instead of gradually lowering rates to those terminal levels, and then getting back into the twos, which is what the expectation had been in June. It seems like they're going to cut quickly to get rates down into the threes and then hold rates at those levels for longer. That's just based on the differences between what their summary of economic projections were in June and September. Color me shocked that they
Yeah.
cut as quickly as they did. I thought it would be more of a wait and see mode, and it wasn't. Um, we'll see, but
Yeah. And the market was an interesting reaction. The market, initially all the indexes, when the announcement came out, indexes were all up more than 0.5%, but we're kind of maybe waiting for hear what Powell had to say. Then they fell. The markets were down. All three indexes were down by the end of the day on Wednesday after Powell spoke. And then, of course, by yesterday, they're all up more than 1.5%.
yeah.
And it seemed like the rally is on. Here it is. Small caps too, which we'll get to. Um, so yeah, it's hard to. I wonder what it was. I think they were looking to see what Powell was going to say about jobs report. Like, yeah,
Yeah.
we're spooked by that. He said, jobs market is still solid, but we're keeping an eye on it. Not saying a whole lot, but I guess that's Fed speak for, yeah, we're a bit concerned.
The one thing that stood out to me was looking at job losses. He had mentioned like immigration influx as being a net addition, but with a lot of lost jobs in native born Americans. But if you drill down into the BLS numbers, it's not so much that like immigrants are coming in and stealing our jobs. It's more that the jobs that are open are the jobs that native born Americans don't want.
Hmm.
So the messaging around jobs and the job loss attribution by Powell, I think is probably a little bit confusing to the market because what we're in environment wise is a period where we are constantly getting negative revisions to job figures. The 50 basis point cut, I think, surprised, it was 60-40 was the expectation
Yeah.
for 50 or 25 basis points. So, we were not alone in thinking 25 was coming. The 50 basis points cut is probably triggered a little bit of worry that they missed the window and they're
Right.
overcorrecting now, right? So there will still be plenty of negative headlines and plenty of things where people are trying to outsmart the market and suss out what's really behind the numbers. Um, and so I think that in the short term, immediately after the announcement, that was certainly influential. And then like you said, the Nasdaq I think was up as much as 3% the next day. It was pretty much an across the board rally. Small caps were up something like 2%.
Yeah. Yeah. Um, so yeah, let's get to small caps. Small caps, I don't think people quite understand how much they've underperformed. I referenced that they've underperformed for 5 years, but the return in the IWM, which tracks the Russell 2000, is 43% over the last 5 years, and that's roughly half. Sorry, less than half the return in the S&P 500, which is 90%. Um, the Russell is still below. It's the one index that's still below its 2021 highs, pretty significantly below. I mean, IWM, here, I'll pull up IWM chart versus just the Russell. IWM topped at 241, about 242 in October 2021. It's right now, it's still only at 216. Even like the equal weight index is up a bit from, during that time. Small caps have severely underperformed. Now they started to, build some momentum lately, and they got a big spike in the last week. They're up. IWM is up, 10.5% year to date, but almost, most of those gains have come in the last month or two. And as Tyler said on this podcast, they tend to outperform large caps, over time. They tend to outperform 3 out of every 5 years. It's hard to just say like they're due, but I mean they're overdue in this case.
Yeah, yeah, I would agree. I like on the one hand, the business conditions were particularly bad for small caps with higher interest rates because a lot of borrowing by small cap companies is done at variable rates. It's a lot harder for, a small manufacturing company to issue a bond and borrow at a fixed rate for 30 years. So they're going through lines of credit and things like that are more likely to have higher and variable rates. So a high rate environment is bad for small caps. The Mag 7 component of it is also is also a net negative for small caps. We are seeing, or we have seen, more of a push towards passive investing and away from active investing. Passive investing meaning you're buying like an S&P 500 fund, like a VOO or SPY or whatever. The problem with the passive investing is you're allocating like 40% of your portfolio to large cap US equities and you're allocating like 10% to small caps. And
Yeah.
then by virtue of how the S&P is constructed, the stocks that grow the most represent the biggest chunk of the S&P 500. And because we are doing more passive investing collectively, they're also attracting more investment dollars, which then causes them to, cyclically causes them to become larger. So an environment that is on the business, in the business condition side, bad for small caps, plus a less active investing environment, I think is kind of a perfect storm for small caps. This is one category that I am very bullish on going forward.
Yeah.
Like maybe we get an October surprise. I don't know what the market's going to do in the next 6 months, but I'm pretty confident that in the next year it'll be higher, especially if this soft landing thing is landing as the Fed seems to be expecting, or is doing everything they can to hit on it. But I think small caps are finally in a position where they're ready to outperform,
Yeah.
and it's probably just getting started for them. They
Uh,
don't have valuation concerns the same way the big
right.
cap tech has.
Right. And I think that's where, you talked about where all that $6.3 trillion in money market funds is going to go. Yeah, I think, a lot of people, especially institutional smart money types, are going to see, or maybe they've probably already had their eye on, like, this is where there's value. There's a lot of places with value, but small caps, no more than small caps. As I mentioned, Russell is the one index that's still below its 2021 highs. And, for this to be a traditional arena for growth and be underwater for almost 3 years, there's, tons of value there. And I think money's just going to come pouring into that sector.
Yeah, I was going to save this for our main segment later, but since we're on the topic of it now, I want to bring it up. So the last time the Fed did what they are seeming to be trying to do was like 1995. So they cut rates from above 5% to like around 3%, then sort of held them for an extended period of time.
Mhm.
In 1995, the Russell 2000 was up 26%. In 96, it was up 14.7%. And then in 97, it was up 20.5%. So it was a 60% return for small
Yep.
caps compared to like a 30% return for large caps in the same period. That's the best case scenario. That's sort of what we could be entering into.
Yeah, I think
Um,
that's totally in play. I think a doubling of the market over the next 2, 3 years is of large caps is totally in play for small caps.
yeah, I agree. I think you handle it tactically. Like you don't dump every large cap that you own to pile entirely into small caps, but if you're a follower of like the modern portfolio theory and you're like, hey, I'm 10% small caps, maybe I'm 15 or 20% small caps in that environment. Of course, if we get like a return of inflation, if the Fed cuts too quickly, or we get the October surprise, like you never like who knows what's coming. But I'm overweight small caps in this environment. I'm bullish on them for certainly the next couple of years. Even just setting aside the outperformance, they have a lot of ground to catch up just from underperformance for the last 5 years.
Right. Yeah,
So
exactly. Yeah, that's why, I would think that institutions would be sort of salivating over, the opportunity there. Um, okay, and you touched on it briefly, number three in our big three. Has the bottom in the market already come and gone? There's been 4 straight years where the market has bottomed in the second half bottom for the market has come in October. Um, the stocks have fallen in September and October as much, usually between about, 5 to 8%, those last 4 years. Well, I mean, they were down sharply the first week of September, but did the timeline bump up this year because of the rate cut? Or do we think somehow the stocks will pull back again? We do still have, an election hanging out there and other sort of potential existential crises.
yeah, and seasonally, I think these are the 10, I think the 10-day period that we're in right now is like the worst 10 days in the market.
Yeah.
Seasonally, it's tough to really make a judgment call at this point, just
Yep.
since we're right on the heels of the rate cuts. Market's down a little bit today.
Yep.
Technically, we're still sort of set up the S&P's broken out to new all-time highs.
Hmm.
The Nasdaq's lagging a little bit, and I was reading something that Mike Santolo had written earlier
Yeah.
in Top 10 Trader, saying that some of the growth indexes are still sort of throwing up yellow flags. So it's not quite full steam ahead there, but I know he's bullish that we're going to get that the next leg's going to be higher. Um, I'm a little bit hesitant to say we are definitely past the bottom,
Yeah.
but I'm probably like 65-35 that we're looking good going forward, barring unexpected news.
Yeah. My guess would be the bottom is in. So the bottom, um, well, actually, the bottom came in August, first week of August. Those, at least for the S&P, it was 51.86, August 5th. It's now at 56.88. And then we had the other, shakeout, I guess Mike would call it. First week of September, dipped to 54.08. I could see it getting back close to this month's lows. I don't see it going back to August lows. That was a big pullback in second half of July, early August. I mean, S&P was down more than 8%. NASDAQ was down like 13, 14%. That's a big pullback. And, the fact that it's 2 months earlier than usual, I don't know that that matters. And it may have everything to do with the Fed.
Yeah, I pulled up a chart of the Nasdaq, which is the only like we'd sort of talked about, the only one that's not at fresh highs right now.
Hmm.
Um, I want to see a subsequent close above yesterday's close. So I
Hmm.
just want to see the Nasdaq sort of break free of the 18,000 level.
Yep.
That's what I'm looking at as a green light as a bottom confirmation, because then you've got uh, higher highs and you've got higher lows, right? That's definitely definitionally a trend. And it's
Right.
just the like you said, the Fed news is so overwhelming in the short term that
Yeah.
it makes it a little bit tougher to suss out what the long term technicals look like. I think it looks good. Um, Honestly, you from what, a month ago or whatever is probably the right way to play it. Where it's like, hey, they'll stocks are going to come down in September. They'll be at new highs by Thanksgiving.
Hmm.
If you go into it with that mindset and you're like, all right, well, grandma's coming over in a week, I better start buying stocks again because they're about to be at new highs. I think you probably win. I think you're probably
Right.
in good shape if you do that. So I'm not, I'm probably, if I'm looking at growth stocks and tech and stuff like that, I don't like tech still, but if I'm looking at growth stocks, I'm probably not piling in right now. I'm giving it a couple more days. I'm not going to miss out on a 10% or 20% run. I'm going to miss out on 1 or 2%. And I'm looking for more confirmation of an upside breakout on tech to sort of follow the rest of the economy. If I am, in other sectors, I'm probably the confirmation I think is already there.
Yeah. Um, okay. That is our Fed talk for the day. This our big three was entirely related to the Fed, and your take are entirely sort of at least somewhat closely related to the Fed and its impact of rate cuts. That's the end of the Fed talk for today. Now, so for our segment today, featured segment today, we wanted to talk about what are some topics, non-Fed or rate cut or inflation or any non-Fed related topics that we're going to be talking about over the next 6 months. Hopefully, it'll be quite a bit. Hopefully this at least this week took away the dark cloud of the Fed hanging over the market.
Yeah.
As we've said, flipping from foe to friend. So we don't have to talk about, Fed angst hopefully won't be a thing anymore, or at least for a while. So what are things that are going to make headlines or that we'll be talking about over the next 6 months? We chose 6 months. A year seemed too far out to predict. End of the year didn't seem far out enough because it's barely more than 3 months. 6 months seemed like a good sweet spot. We each chose three. I'll let you go first.
All right. My first one, I'm gonna say that it's space, but I don't just mean space. I joke to you that we are now a space podcast once the Fed
Hmm.
cut rates. Um, what I mean specifically, and part of this is like Intuitive Machines, LUNR is up like 50% a week on a new NASDAQ contract. Rocket Labs is up like 7% today on I think I said NASDAQ contract, NASA contract, on a NASA contract. ASTS Space Mobile was a big winner over the summer. What I mean when I say that space is going to be something we talked about, we're going to see something that we have talked about a number of times, sort of indirectly, which is identifying opportunities that maybe were not previously available or were not obvious enough to justify investing in. Because we're in an environment that is way more favorable if we've got a lot of money coming off the sidelines into the market, if we've got interest rates going down, that's a lot more favorable to speculative technology investment, to new products, new services. We had talked months ago or maybe last year about how there's sort of a lack of new ideas in the market. Like where's the Segway? Where's the Beyond Meat? Like where are those kinds of products? Those
Yeah.
kinds of products thrive in an environment where money is easier and where investment dollars are easier to get. So I think that we're going to see more novel products. I'll position it that way. People are tired of AI. They're done with it. They're looking for
Mm.
opportunities outside of it. So I think that's going to be a driving force. Right now, that's in space, and that'll probably sustain for the next 6 months, maybe as far as next year. There's a federal initiative to try and find more contractors to provide uh, what is it? It's up mass services, so like getting satellites to orbit, stuff like that. I think Musk came out recently and said that the goal now is to have people on Mars in like 2 to 4 years, something
Yep.
along those lines. So I do think it's going to be in the zeitgeist again. It's space for now, but it's going to be novel products, novel services, and bigger swings. So the moonshot stuff. Moonshots. That's a better way to say it.
There we go. Yeah, there hasn't been a whole lot of, if you're looking to invest in space, this is outer space. We there hasn't been a whole lot of options until recently. As you mentioned, AST Space Mobile, Rocket Labs now. We're even seeing the sort of space fever, mini fever, I guess you could call it, showed up. United Airlines the other day reported that they're going to start to offer free Wi-Fi on all their flights because they're hooking up with Starlink.
Yeah.
They're going to have use Elon Musk's SpaceX satellites to offer free Wi-Fi on all their flights. And that's sort of a new trend. But I think people that caused United Airlines stock UAL shares to spike from 49 to almost 53 pretty much overnight. Just a couple days. It's the highest the
That
stock has been in a few months. Sorry, go ahead.
that I don't get. I do not get why UAL would rise on Starlink providing Wi-Fi instead of Viasat, I assume is who was doing it before. Like, I'm
Yeah.
not going to take an extra flight to Chicago because I can now use Starlink Wi-Fi.
Well, I think it's free. The free Wi-Fi is the part that probably got people. I mean,
Yeah,
but
the
UAL
news is
has the
good
whole,
news.
UAL is been extremely undervalued for a while, so maybe more about that and market forces. I don't know.
Just a marker of innovation and a willingness to make changes. Like
Yeah,
maybe that's enough. Like, hey, we
maybe.
care. We're doing something about it.
Right. Yeah.
Um, yeah,
Yeah. So anyway, yeah, I think space. The There hasn't, like I said, there hasn't been many opportunities to invest in space, and now you can. So I think that there's some intrigue there.
yeah. The big ones now, just for anybody that's looking, ASTS obviously is the big one. They launched their Bluebird satellites. Now I think they have to unfurl them. They may have done that.
Yeah.
LUNR is Intuitive Machines. Rocket
Mhm.
Lab is RKLB. Redwire, or not, yeah, RDW. And then you've got Virgin Galactic, but they seem to be sort of doing nothing. Amazon has
Yeah.
their Blue Origin. So there are more names out there and they are getting press. But if you're interested, those would be the tickers I would start with.
Yeah. Okay. My number one. Start pretty simple. Election. Um, so the next 6 weeks, it'll be. We talked about maybe the market could pull back and possibly match its lows from earlier this month. That I don't know if there's a level of election angst that would do that, but I think this sort of Fed has been the thing that's been the dark cloud hanging over the market. I don't think the election's a dark cloud. There's one every 4 years, and they're usually about as uncertain as they are as it is now every 4 years. But that's why there's a reason there's a pattern of this market being flat to down in the 2-3 months before an election. So that's just something that could, prevent a true rally from forming until after the election. And then post-election, the pattern, especially the last three elections, doesn't matter who wins, what party wins, what candidate wins. The last three winners have been Biden, Trump, Obama. Regardless, every time the market stocks have taken off after the election, just because the market has an answer. As I've said before, the one thing that could maybe the market wouldn't like is a 2000 situation, Bush Gore, where there's hanging chads and uncertainty for a couple months. So barring that with Harris and Trump, I think once we get past the election, it could be like last November, which was not election related, but is post October related. Once we get past November, people could really feel free to start pouring into the market. So I think election, of course, there's going to be endless election talk the next 6 weeks in the mainstream, but I think it's going to be a pervading topic investment wise in the next 6 weeks. And then after, if stocks take off and be like, oh, look at how well stocks are doing under, it's going to be a
Whoever.
new-ish president
Yeah.
regardless. So that'll be a big
The one thing I would have that you didn't mention on my radar potentially is like the blue wave. right? If it's a blue wave election, that raises the likelihood of antitrust action. We've already seen moves against Google by the current Justice Department, because that's sort of an endorsement of that position. Also, if you've got stuff like, a concerted push for Medicare for all, which I would be a net supporter of because it saves like 30% of administrative costs for the cost of healthcare in the country, but it's bad for insurers. So I think that there's maybe some risks to like a blue wave. I don't know if we get it. I don't, but that would be one on my radar as well. That for maybe a post-election that could contribute to a post-election dip that we might not see coming.
Yeah, maybe. That's, theoretical.
No.
I that's why I'm sort of positioning as, it doesn't matter which party's won the last three elections. We've seen stocks take off. 2008 was the last time they didn't, and that was in the middle of the worst recession since the Great Depression.
That's
So there were other things going on there.
Yeah,
Uh,
that's the tough thing with elections as data points is, well, we get one every 4 years, so it's by default a small sample size, but
right.
um,
Yeah.
and I think Wall Street likes gridlock because that means no rule
Yes.
changes, no uncertainty. That's
Yeah.
if we get, Republican congressional control and then like uh Democratic presidential and Senate or something like that, I think the market
Yeah.
responds just fine.
And regardless, this is something that we're going to be talking about the next few months. Without getting into the politics of it all. But I think, ramifications of, both pre and post election will definitely be a big theme. Okay, what's your number two?
So my number two is jobs. Bears, doomsayers always need something to be worried about. They always need something to complain about. We talked about it a little bit earlier. I think jobs is the thing, um, right? If inflation is gone and the Fed's on our side now, well, what's the next thing to worry about? Jobs. What
Hmm.
what form are new jobs taking? Disproportionately affecting white collar workers, or job losses right now are disproportionately affecting white collar workers, and we're seeing more hiring among low skill labor, home health aides. Actually, healthcare has been in sort of a net. Uh, so net on net is sort of a hiring spree for like physician's assistant, home health aides, stuff like that. If you look at the BLS data, it's the private employment and healthcare services. Actually, what's the private education and health services category in the last 12 months has been far and away the largest net hirer,
Hmm.
with government being second. So the form that the new hiring takes, where the layoffs are happening, that's going to be a lot of the conversation is, hey, because we've had something of a K-shaped economy for the last year or two where people on the lower tiers of the income ladder are sort of underperforming. They're feeling inflation more, they're seeing wages go up, but uh, cost of living is rising sort of commensurately. But most of the benefits are accruing to the investing class and professionals. But the one thing that I continue to be intrigued by is something Bruce Kaiser wrote about way back in the day, a couple years ago. He wrote about whether we were having what would essentially be a sector by sector rolling. I don't want to quite call it a recession, but rolling weakness across different sectors. Um, and if that pans out, if we start seeing tech hiring pick up, the service hiring has already been strong, but if we see tech hiring pick up, if we start seeing then manufacturing hiring pick up because the consumer feels better and the demand is sort of refreshed, that would be net bullish. But I think you'll see a lot of sector breakdowns by where jobs are, where they're coming from, and whether that's something to worry about. But the reason it's on my list is because Bears got to worry about something.
Yeah, I mean that other than just general pre-election malaise, that probably is the true catalyst is the wrong word, reverse catalyst that could weigh on markets the next couple of months, or send them tumbling. Yeah, jobs are going to be, until the jobs report improves or at least doesn't fall, well short of expectations that like it has the last couple of months. I think that'll be something that people are concerned about, and the Fed's concerned about. I mean, the Fed's obviously taking a proactive stance. Um, But the more that the unemployment rate rises, the more times the jobs report, hiring comes up short, the more fear of a recession, regardless of what the Fed is doing, is going to creep into the market.
Anecdotally, I've seen reporting that recruiters are more active now, just in the last couple of days after the Fed rate cut. Like
Really?
that answers a lot of questions for how much are you going to have to pay to borrow money to hire new employees to, start building your business out. It's anecdotal, but that's something that I've seen
Yeah.
early. So everything's sort of operating as it should, right? The Fed's goal was to lower the employment rate a little bit because the job market was too hot, but now it's just navigating is it an overreaction? Have they put their thumb on the scale too much? But that'll be a common talking point for a long time until, as you said, until we see a lot of stabilization in it, and then the market can put it behind it.
Okay. My number two, anything real estate related. Now, they're not all created equal, and it's important to note that the Fed cutting rates, those are short-term interest rates. They don't have anything to do with 30-year mortgage rates. But generally, when the Fed cuts rates, mortgage rates start to fall. Well, they already were starting to fall prior to, in anticipation of this cut. Um, and I wrote about and have talked about here. I like home builders in particular. Better margins, better sales. Seven. What was it? What was the peak of mortgage rates? It was over 7%, right?
Yeah,
And now is what, in the low six? Is it down
I
below?
think it was 6-1 earlier this week.
Yeah.
It may be in the 5.9s now. I don't
Yeah.
know. I'll pull that up.
That sort of, it's beyond just sticker shock. It's just, that makes for a much more expensive home buying proposition that's really been weighing on the real estate market. When when the Fed starts to cut rates, um, and mortgage rates start to come down, the home builders are sort of the first to get going. Now, it's in investing, you know, usually when you group sectors together, everything sort of gets lumped together just under the real estate, umbrella. You're sort of investing in a theme or a narrative rather than like, well, Zillow's not going to go up, but these home
Yeah.
builders are. So I think that's why I'm putting it sort of all under I think it'll lift all boats in the real estate sector. But, home builders, we've seen a spike in the ITB, which is the home construction um, ETF. It's up from 117 to 126 in just the last 9 days, with, big spike happening since the Fed cut rates, and that's the pattern. The last time the Fed cut rates, now rates weren't as high, but pre-COVID in from December 2018 through actually, sorry, it started in mid-July. The Fed started cutting rates from 2.5% to 1.5% from mid-July of 2019 till February 2020. And during that time, the home builder stocks were up 15%, like double what the market was up. Um, and they actually started going up first half of 2019 after, the rates had sort of flattened out after they'd been raising them. Um, so home builders are what I'm most sort of bullish on personally, but I think real estate is a theme. Real estate stocks, people getting back into REITs, getting back into, home builders, but also things like Zillow. I think that's going to be a theme over the next 6 months because that's sort of one of the more direct beneficiaries of a lower rate environment.
Yeah, I like it. The 30-year average 30-year mortgage as of yesterday, according to the St. Louis Fed, is 6.09%. So still in the sixes,
Yep.
but really low. New builders have a couple of advantages going for them right now. If inflation is on its way down, raw input costs are not rising nearly as quickly. So things like lumber, paint, concrete, right? Those costs get more in control, and their ability to offer rate promotion, stuff like that. The magic number that I think we talked about last week is somewhere around 5% for most
Hmm.
home buyers, according to polls and surveys and things like that. Um, if the prevailing 30-year rate is 6.09, but you can get it at 5.25 from a new builder if you go to their preferred lender,
Yeah.
that gets you pretty close, right? It's close enough
Right.
for Army work. So I think there's a lot in favor of home builders right now.
Yeah. Okay. What's your number three?
It's small caps. I'll keep it short because we've already covered it a lot, but small caps. I think this is going to be a major theme for a while, definitely into next year. Because small caps are poised to outperform. They've got a lot of room to catch up, and then even once they catch up, they've got a lot of room to run. Um, I think we'll be talking about the performance of small caps. I think we're going to be talking about more of those moonshot projects that I had mentioned earlier, which are probably going to be driven by small caps. It's small cap summer, or I guess small cap early fall right now.
Yeah. It feels like summer where you are. Still summer, technically, for 2 more days. Yeah, I mean, I'm the guy that came on here with the defend the take, what, a few weeks ago and said I thought that the Russell 2000 would reach new all-time highs by year's end, which I think would require, from when I said it, like a 14, 15% bump. Is that
15%, right? And it's probably
right?
what, 10% now?
Yeah, I I'm sticking to it. I left that one to you. But I guess what we're talking about here is what would be some of the biggest themes of the next 6 months. Small caps would really have to spike to become a theme because they, by their nature, are sort of under the radar. But I think we're going to get that big a spike. So I agree with you.
Yeah.
My third is is a louder one that gets a lot of attention in good times, and probably a lot of attention in bad times too. Bitcoin. Um, I've had takes about this too, where I thought it going to reach record highs, which it did earlier this year, 73,000 in March. Um, it's a bull market play, Bitcoin. It's since fallen as the market has sort of weakened over the course of the year. It's fallen back, dipped as low as 53,000 a couple times in August, and then when the market pulled back first week of September. I mean, if you put like the Bitcoin chart right over the S&P 500, it's just an exaggerated version of it.
Yeah.
It's almost like a 2 times, 3 times leveraged ETF to the market. Um, so this is on the premise that I think the market's really going to take off and go to new high, not only go to new highs, I mean, it already is, technically, but it's going to be a broader rally with small caps involved, with other sectors beyond the Mag 7 and AI involved. And so I think Bitcoin tends to spike when there's real market, you know, frothiness, I guess, which is exactly what we saw from last November until this February, March, and sure enough, Bitcoin went from during that time. So let's see, heading into last November, well, we'll go mid-November last year, Bitcoin was 26,000. By mid-March, it was at 73,000. So, nearly tripling. I don't think that's going to happen. It's still at 63,000. It's still high. But as a bull market play, I think Bitcoin will really start to rise again, and I think it'll push past 73,000 pretty easily. If not by the end of this year, then early next. So within our 6 month window we're talking about here, and I think it'll rise to the point where it gets talked about again, and people are starting to talk about here's why you should invest in crypto. Um,
Yeah.
I we both said we're not big believers in Bitcoin as a long-term investment. I like it as a bull market play. And, I think when Bitcoin gets talked about everywhere and like, your neighbors and your friends are asking you about it, like, hey, should I invest in Bitcoin? That's the time to sell Bitcoin. We're certainly not there yet. We don't hear much about it these days, but I think we
No.
will. We will in the next 6 months.
Yeah, my question for you was going to be, does it hit a new all-time high this calendar year, which is, does it break 73?
Yes,
Um, yeah, as much as I'm sort of jaded by Bitcoin,
me too.
I agree with you.
Yeah.
I think 80, 90 is in play early next year, assuming the market cooperates. And like you said, it's an extension of the bull market. Um,
Yeah, it would be to get to new highs would require about a 16% bump from here. That's not nothing, but Bitcoin, like I said, it's sort of almost like a leveraged fund. It rises quickly. I mean, it's up from 53 to 63 in the last 2 weeks. Um,
so so
so
maybe the play is buy Bitcoin, and then depending on how many people at your Thanksgiving table are talking about it, decide whether or not to sell
yes, yeah,
in 2 months. Um,
yep.
I what level of return would you need to see to be like, I'm buying Bitcoin here? Because for me, it's like 100%. I,
I
like
mean, what level of return
of
would
like
would I
upside.
need
So
to? Yeah, yeah, yeah. I mean, that's why I loved it when it was at 26
yeah.
last. 63. And I don't think it's rising to 126, 127. I don't see that. Uh,
So so
so
20%, so like 16 to 20% to go from 63 to hit new all-time highs. Probably not enough for you to jump in just given the volatility. But what about 90, 96? You make 50% maybe. Is that like, what sort of upward price target would you need to have in mind to justify taking on the risk and the volatility?
I would need. I'd say at least 75%. And so
Yeah,
I'm putting this in here as something we will be talking about
sure.
in the next 6 months. Do I recommend buying it here? No, maybe 2 weeks ago when it was 53, if we weren't talking about it then. But even then, I don't even know if it'll top 100. Maybe it will. If it does, you'll hear about it.
Yeah.
And when you hear about it, again, time to sell. But Bitcoin will become a theme. So I think just the fact that I'm saying it's become a theme, not only new time highs by the end of the year, I agree. I think it's going into the 80s, by early next year. And yeah, maybe 90. 100, I don't know if I can get there. But we'll see. We'll see how just strong this next leg of the bull market is. Okay, so we've each done three now, right?
Yep.
So to review, mine are election, both pre and post, real estate, home builders in particular for me, but just all things real estate, I think will be a topic in the next 6 months, and Bitcoin reaching new highs. Your three are,
Moonshots, jobs, and small caps.
yes, moonshots meaning space, outer space.
Not specifically outer space is the sort of the picture of moonshots right now, but I think it'll evolve, but it'll be more moonshot projects right now, as evidenced by space.
Okay. Well, I think this will be a perfect list. I think we'll be. I mean, the great part of this
Yep.
is we make our own schedule. We talk about what we want to. So we could just put all six of these, regardless of what they're
Let's
doing,
talk
on
about
Monday.
Bitcoin every week, and
Right?
then
Yeah, yeah. As long as we talk about it once in the next 6 months, then that'll be enough. Okay, well, that's it for us for this episode of Street Check. As always, like and subscribe whether you're watching us on YouTube, Cabot Wealth Network videos channel, or listening to us on Apple Podcasts, wherever you get your podcasts. Like, subscribe, give us a 5-star review, and if you have any thoughts or other ideas about themes that you think are going to pop up in the next 6 months, feel free to email us at streetcheck@cabotwealth.com. Any final words, Brad, before we sign off?
no,
No. Okay. Man, a few words.
I'm not making it easy for you. No,
Yeah.
that's it.
All right. We'll see you next week.